So I have 30 formulas today, and these 30 would cover most of your equity level 2 formulas. Number one is holding period return. What should be the formula? P1 dividend received plus capital appreciation divided by the original price, which is going to be price at time 0. So which means we can simply say D1 plus P1 minus P0 divided by P0. This is your holding period return. Should we do the next one? Yes, so we have two parts to this. The first one is Gordon growth model for equity risk premium. What should be the formula for this? GGM for ERP, equity risk premium. Okay. Now again, you don't have to remember this. Okay, so you can always derive this formula. Equity risk premium means that how much our shareholder expected to earn. So we can call that as R minus RFR. Correct? That's equity risk premium. So we can use Gordon growth formula and derive this. What is the Gordon growth formula? V0 is equal to D1 divided by, yes, what is the Gordon growth formula? R minus G. So what we need to find out is we need to find out R. So R minus G is going to be D1 by P0. So I can say R is equal to dividend yield. Correct? This number is nothing but dividend yield, and this G would shift here. So dividend yield plus growth. But we do not want R. What we want is equity risk premium, which is R minus RFR. So minus RFR would give us the equity risk premium as per Gordon growth model. So what is the formula? Formula is that dividend yield plus the expected growth rate minus the risk-free rate of return. Are we okay? I'm repeating the formula again. Equity risk premium as per the Gordon growth model is equal to dividend yield plus the growth rate minus risk-free rate of return. Should we move on? Yes. Formula number 2A. Find out equity risk premium using Ibbotson and Chen model for ERP. Yes, who remembers it? This model has also been called as supply side model. Okay, so Ibbotson and Chen model or supply side model, same concept. The formula is, on a very broad level, the formula is price appreciation plus dividend yield minus RFR, because price appreciation plus dividend is total return minus RFR will give you equity risk premium. So how we can expand this is, we can say 1 plus expected inflation into 1 plus expected growth in real EPS into 1 plus expected growth in price earning ratio. So when you do these three, 1 plus expected inflation into 1 plus increase in real EPS into 1 plus growth rate of P ratio, this gives you capital appreciation. Minus 1, because we've added 1, we will say minus 1 plus the dividend yield, which also includes the reinvestment income, and then this is the total return that you earn on equity, minus RFR will give you equity risk premium. Are we okay here? Let me repeat the formula quickly. 1 plus expected level of inflation into 1 plus growth rate of EPS into 1 plus growth rate of PE ratio. Since we've added 1, we will say minus 1. The whole term plus dividend yield, this has been also including reinvestment income, minus RFR. This will give you equity risk premium as per Ibbotson and Chen model. Are we good to move? Next formula. Now in sheet 3 we have to find out most of the cost of equity formulas. The first one is CAPM, capital asset pricing model. The formula is RFR plus beta into equity risk premium, which is calculated as return on market minus RFR. Then the next model for calculation of cost of equity is FEMA and French model. So what was the FFM model? Yes, there were different premiums. So what you need to remember with FFM, there were 3 premiums. One for equity, one for small cap stocks, and one for high book to market price. That means value stock. So what is the formula? The formula for FEMA and French model is RFR plus RMRF into beta of market. What is RMRF? Return on market minus risk-free rate of return. Nothing but equity risk premium. Plus, yes, SMB. SMB is small minus big. So small cap returns minus large cap returns into the beta for SMB plus HML. High minus low into beta for SML. So I'm repeating it again. FEMA and French model. We've got 3 important factors. One for equity, one for small cap stocks, and other for value stocks. So RFR, which is the intercept, plus RMRF, which is return on market minus risk-free rate of return into beta of the market. So this was the first factor, plus SMB into beta of SMB. SMB is small minus big, return on small cap stocks minus large cap stocks into the beta. This was the second factor. And the third one was high minus low, return on high book to price, the inverse of price to book ratio. High book to price value portfolios minus low book to price value portfolios into the beta stock. The third factor. Sorry? Yeah, that should be beta HML, respective betas. Again, important thing that we studied is that neutral value of the beta is 1 here, but neutral value of beta for small minus big and beta of HML is 0. Meaning of neutral value is that if your actual beta is more than that, then that means the stock is small cap, or the stock is value stock. Are we good to move? Yes, the next one is Pasteur and Stambaugh model. Yes, so exactly the same FFM, we just add a 4th factor to it, which is liquidity premium into beta of liquidity. So which means we just incorporate illiquidity of the stocks, add premium to it, and then we have the Pasteur and Stambaugh model. Are we good to move further? Higher than 0. That means stock is illiquid, and therefore you want to earn some premium there. Yes, next one is adjustment of beta. We saw Mule's model for adjusted beta. Yes, what was the formula? 2/3 into regression beta, the beta that you have calculated, plus into 1. 1/3 into 1, the reason being that this 1 is the mean of beta, mean of all the betas in the market, and therefore this model gives you what is being proposed by mean reversion concept, that with time data tends to move towards its mean. Should we move on? How do you calculate weighted average cost of capital? Formula number 4. Simple. So weight of debt into after tax cost of debt, which is cost of debt, let's say, which is KD into 1 minus T, plus weight of equity into cost of equity. Gordon growth stock valuation model, again straightforward. Value at time 0 is equal to dividend of time 1 divided by K minus G, or simply R minus G. R being the cost of equity, G being the perpetual growth rate. Next formula, value of perpetual preferred stock. So value at time 0 is equal to dividend at time 1 divided by required rate of return from preferred stock, so KPS, a simple formula of perpetuity. Are we good to move here? Formula number 7, PVGO. Value at time 0 of a stock is equal to E divided by R plus PVGO. Okay. Now, does it have to be E0 or E1 or E2? What should this be? E1? So it doesn't matter. Why it doesn't matter? Because here the assumption is, what if my current earnings remain constant forever? So for example, let us say my earning per share is 10 rupees. Required rate of return is 10%. So if my earnings remain constant, then value of my stock should be 100. But if the value of my stock is actually 150, then 50 rupees is on account of PVGO. Are you following this? So therefore it does not matter what E we are taking, because we are anyways assuming that E is going to remain constant. So which means PVGO, present value of growth opportunity, is equal to V0 or P0, current market price of the stock, minus E divided by R. Should we move on? H model for calculating value of stock using dividend discount model. When do we use H? Yes, when you come across the word linear, that there is a linear decline from one stage to another. So here the formula is value of stock at time 0 is equal to D0 into 1 plus G long run divided by R minus G of long run plus. So what we have done here, if the dividend was to always grow at constant rate and if there was no high growth period, then this would have been the value of stock. But because there was some high growth period, that excess value we calculate by saying D0 into H. And what is H? Half of high growth period. Half of high growth period. So into H into GS minus GL. Short term growth rate minus long term growth rate divided by R minus GL again. So let's try to remember it. Value of stock at time 0 is made of two parts. Now again, be careful that here we do not use D1 in the numerator. And this numerator is not necessarily D1. Try to understand why. Let's assume that my current dividend is 10 rupees. There is going to be a high growth rate of 20% for 4 years. And then it would start growing linearly. Or in fact, let's say high growth rate of 20% and then it would start growing linearly. So my actual D1 is going to be 12 rupees. But in the formula, we are saying D0 into 1 plus GL, the long-term growth rate. So the numerator is not D1, it is D0 into 1 plus GL divided by R minus GL plus D0 into H, which is half of high growth period, into the difference of two growth rates divided by R minus GL again. So in denominator, both the places we have GL. Are we good to move? No, it's not. Okay, let's next question. Sustainable growth rate G can be calculated by saying return on equity into retention ratio R. Return on equity we can further expand using DuPont formula. So net income divided by sales into sales upon assets into assets upon equity. So we can also have a 4-factor formula for sustainable growth rate. Net income by sales into sales by assets into assets by equity into retention ratio. Should we move on? Next, value of firm and value of equity using FCFF and FCFE. So when you're using FCFF, you should be discounting that with WACC. And when you discount FCFF with WACC, what you get is value of firm. Once you have value of firm, from that you reduce value of debt. And then what you get is value of equity. So this is one approach. That discount FCFF with WACC, it gives you value of firm. From value of firm, reduce value of debt and then get value of equity. The second approach is calculate FCFE directly, discount FCFE with cost of equity, and then what you'd get is directly the value of equity. Should we move on? Formula number 11. How do you calculate FCFF starting from net income? Abhimanyu. Mohit. Net income plus non-cash charges.
Plus interest into 1 minus tax.
Mm-hmm.
Minus fixed capital investments minus working capital investments.
Yes, okay. So how I recommend remembering this is try to convert everything to CFO first, and then with CFO remember that there are two things to be adjusted. One is interest and other is fixed capital investment. So if I have net income plus non-cash charges plus or minus working capital investment. Okay, so if my working capital is increasing, this number would be negative. If my working capital is decreasing, this number would be positive. These three numbers would give us CFO, and then once you have this, you make two adjustments. One for interest, because from net income we've reduced interest, and FCFF we want cash flow for the whole firm, so interest should not be reduced. So interest into 1 minus taxes, and again plus and minus fixed capital investment. So most of the time this number would be negative because you would be investing into new assets. Are we clear? Next one, so I'm repeating it one more time. FCFF starting from net income is net income plus non-cash charges plus or minus working capital investment. This gives us CFO. Then plus interest net of taxes and plus or minus fixed capital investment. Next formula is FCFF from EBIT, Pankaj. How should we calculate this? Yes, so start with EBIT and multiply that with 1 minus tax. Now that EBIT is before interest, and therefore you would not be required to add back the interest again. And anyways, when we were adding back the interest, it was interest into 1 minus T. So we were adding back lesser amount. We were not taking the benefit of taxes. So here on EBIT, when we say 1 minus T, we are doing the same thing. We are reducing large taxes, more taxes than what we are actually paying. So that interest adjustment is done. So when I adjust this for CFO, when I adjust this for working capital investment, what this number gives me is, plus non-cash charges. What this number gives me is CFO plus interest net of tax. Okay, so CFO plus interest net of tax I get directly, and once I have, then simply plus or minus fixed capital investment, and then you get FCFF starting from EBIT. So let me repeat it again. FCFF starting from EBIT, EBIT into 1 minus T, plus or minus, so plus non-cash charges, plus or minus working capital investment, and plus or minus fixed capital investment. Should we move? FCFF starting from EBITDA, Karthik. So again, what is the formula? EBITDA into 1 minus taxes. So here what you're doing is, you're not taking the benefit of interest for tax deduction. You're also not taking the benefit of depreciation for tax deduction. interest you should not be taking, but depreciation you should have. So we add back that depreciation separately. So EBITDA into 1 minus T plus depreciation into tax rate. So we take the benefit of taxes on depreciation. And when we adjust this for working capital investment, here what we get is CFO net of plus interest net of tax. And then once we have these two, simply say minus fixed capital investment. Should we move on? Next one, FCFF starting from CFO, the easiest one. So CFO, then plus interest net of taxes, which would be interest into 1 minus T, and then minus fixed capital investment. Next formula, FCFE starting from net income. Yes, how should we solve this? Anuja? Net income plus non-cash charges. Plus or minus, or let me just simply say minus working capital investment. What is this number? CFO. So again we have derived CFO here. Now should I add back the interest the way we did it for FCFF? No, we don't have to, because when we are calculating cash flow for equity, we are supposed to pay interest. So we don't add back interest here. So what should we adjust this for now? So minus fixed capital investment and plus and minus net borrowing. So if you've taken money, if you've taken loan, it would be plus. If you've repaid loan, it would be minus. Are we good to move? So CFO minus fixed capital investment plus or minus net borrowing. FCFE from CFO, the same formula. So CFO, then net borrowing. Simple 3-step formula. CFO plus or minus fixed capital investment, or minus fixed capital investment plus and minus net borrowing. Are we okay here? So let's take a very small break for myself.